I'm David Shaw, editor and publishing director of Directors and Boards and Private Company Director magazine. Today I interview Irv Becker of Korn Ferry Hay Group on compensation and the board. With me today is Irv Becker, Vice Chairman, Executive Pay and Governance, Korn Ferry Hay Group. Our topic today is compensation and the board. Thanks for being with me today.
Thanks for having me.
As we speak, the stock markets are at or near all-time highs, and yet economic growth remains somewhat sluggish. This seems like a very difficult situation for compensation committees to deal with in terms of executive compensation. What are your thoughts on that?
No, that's a really good point, and it is a challenge for comp committees. In an environment where they're not seeing the growth really on the top line. They still obviously want to align the executives with the shareholders, and they're still looking to help them by reinforcing the total shareholder return, which is a very important metric. I think, though, as it relates to their compensation, they're really looking at the long-term comp component. So, when companies are growing, it's very easy to make changes to salary and increase salary or to increase the bonus. But we haven't really seen that, again, in the recent period. And so if you have a high-performing CEO, the board is struggling to, well, how do we reward that person? How do we provide a thank you, to the effort that they're involved in, and so boards are really looking at the long-term component of pay, and they are. It's the easier place in the mix of CEO comp for them to increase those numbers, and so we did a recent study recently of top 300 companies, and we showed that the salary and the bonus numbers were really barely moving. But the long-term incentive compensation number, the long-term comp number, was still moving at a pretty significant rate and has been for a number of years. So it just seems that that's the easier place for the committee to make those changes. It does align with long-term growth because there isn't really the short-term growth that we're talking about. And I think it's easier for them to rationalize that. It's easier for the shareholders to understand that. And at the end of the day, if the companies continue to grow over the long term, that incentive will pay off for the CEOs.
So as a comp committee is thinking about the next couple of years, you had mentioned TSR as a measure. Are there other measures that they ought to be examining at this point as they're strategizing for a couple of years of maybe stock market wobbling and economic wobbling?
So TSR is still one of the leading metrics that we see in these types of long-term incentive plans, and that makes sense because, again, it is the alignment with the shareholder. So it's again an easier decision for comp committees to use that metric. Well, we're starting to see companies pull back a little bit from relying too heavily on TSR because it is not a line of sight metric, and it's also a metric when it's relative TSR, which most of the plans are. The executives really don't know how they're doing until the end of the 3-year cycle because it's not just their performance, but it's relative to their peer group. And so committees are really trying to dig into the long-term strategic plans for their companies and pull out metrics that are more line of sight, that they believe will drive TSR in the long run. And it's just, again, it's going to provide more clarity to the CEOs and to the management team. We talked about the lack of growth on the top line. And so revenue as a metric is something that many of our clients are considering trying to figure out how to bring revenue back into the mix. For many years, companies were more focused on operational efficiency. They were focused on profitability. And so you had earnings metrics, you might have had return metrics. But I think companies that really want to drive the top line need to consider bringing revenue back into one of the key metrics in maybe the short-term plan or maybe the long-term plan. We are also seeing a lot of institutional pressure on companies to be efficient about how they use capital. And so, for example, if you have a company that had done some acquisitions in its past, there'll be a lot of pressure on that company to be efficient with the dollars that they spent. And so we're seeing push from the institutional shareholders to use return on invested capital as a metric. I'd say that's probably the metric we're seeing being adopted the most now as a new metric. Typically, it is used in conjunction with maybe a top-line metric like revenue or an earnings metric. But again, it's an efficiency and metric, and it complements well some of those other absolute metrics like earnings or revenue.
How do institutional shareholders react to the idea of having revenue being a component as opposed to profitability, or maybe not as opposed to?
Well, again, it all has to be in balance, and it's a great question. So whenever we work with our clients on metrics, we step back and always look holistically at both the short-term plan and the long-term plan. And how do the metrics in one plan versus the other kind of work together and feed off of each other? So if you have a revenue metric, let's say in the long-term plan, you're going to probably want to balance that with an earnings metric in the short-term plan. If you have a total shareholder return metric, you might want to complement that with a return on invested capital metric. So there's all sorts of combinations that make sense. None of it is cookie cutter. It's all, it all has to be customized to the company, to the business that they're in, the industry that that they live in. And so every company is in a different place. They really need to understand their industry, their business cycle, the environment they're in, before you really identify what the right metrics are for them to use going forward. But to answer your question, it is clearly, it has to be balanced with other metrics for it to work right.
We're in a period when there may or may not be significant changes in the regulatory structure surrounding public companies. Maybe a rollback in part or in whole of Dodd-Frank. There are issues such as say-on pay or the CEO pay ratio issue that may or may not go away. What kind of compensation committee, what do you see happening?
We don't expect to see significant repeal of Dodd-Frank. There probably are some aspects within Dodd-Frank that may get turned around, but I'm not sure there'll be I'm not sure it'll be say on pay. It may be the CEO pay ratio, but that's still to be seen. Say on pay, I think, is here to stay. Not so much because it's part of Dodd-Frank, but because it is something that the institutional shareholders really want. And I think that there's a cadence now that's been created between the shareholders and the companies about the dialogue, the shareholder outreach that's happening now, proactive shareholder outreach by companies in advance of the proxy season. The give and take and understanding the concerns, the company understanding the concerns that the institutional shareholders have. So I think say on pay has created that dialogue. I think that dialogue is going to be here to stay. I think say on pay will be here to stay. There may be some other parts of Dodd-Frank that haven't been fully implemented yet that may not get implemented, like final rules on clawbacks. We may or may not see that. But as it relates to CEO pay ratio, which is really the one that everyone's curious about, that's actually law, right? So unless anything gets done between now and next proxy season, companies are going to need to comply with that. And I think it's a real concern for many companies because for a long time, for the last 6 to 9 months, I think companies have thought that would get taken away, that would get repealed. And so a lot of companies haven't necessarily done the homework they need to do to be ready for that. We've clearly been advising our clients that this is something they should be modeling in 17 with 16 data so they can understand how to make that calculation because it's very complicated, but also to start preparing the committee, the comp committee, with what those numbers might look like, and start getting ready for the potential fallout from that kind of disclosure. So one of the biggest issues with CEO pay is not so much the disclosure of the CEO's compensation, because that's already been disclosed, but it is the disclosure of what the median employee's compensation will be. This presents all sorts of issues, unintended consequences for the company and for the human resources department, because half of the employees will be upset because they'll be below that median employee pay. But also your competitors are going to be disclosing that information as well. And if your median pay is below your competitor's median pay, that will raise issues as to the overall comp philosophy of the organization. So I think that's a huge area that's going to be an unintended consequence of this disclosure. And I think companies need to get ready for that, and they need to start working on the communication for that.
Thank you very much for your time today.
Thanks for having me.
Thank you for watching. If you have comments or questions, please email me at dshaw@directorsandboards.com. And make sure to tune in to our other videos at www.directorsandboards.com.